Hello, good morning, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me well? Okay, so in the last class, we have done two questions, one on APV, one on International Investment Appraisal. So today we are going to start this past paper, June 2023, Joshua Company, WAC, merger and acquisition, and some touch of reconstruction as well. So June 2023, this question we will be doing. So students, the point is, here is the past paper. Yes, I'm opening that. So March, June 2023, question number 1. Yes. So requirements are here in front of you. Discuss the agency problems created by Joshua Company's proposed takeover of Fraser Company as a defense and risk diversification strategy, and explain how these could be mitigated. You see here, 5 marks. Their strategy as a defense and risk diversification strategy, and explain how these could be mitigated. Okay. Really? I'm sorry. I'm sorry. Thank you. So here it is. Thank you. Here it is. Now, shared. So this is the latest past paper, June 2023, available on the practice platform. And the first question is, discuss the agency problem created by Joshua Company's proposed takeover of Fraser Company as a defense and risk diversification strategy, and explain how these could be mitigated. 5 marks. Prepare a report for the board of directors of Joshua that calculate the post-acquisition WAC. So WAC is being tested here. Investment appraisal touch. Estimate the additional value from Joshua Company's proposed acquisition of Fraser Company. Additional value to shareholders. That if they acquire Fraser Company, what is the benefit? Additional benefit to the shareholders. Now, so the next is compare shareholders' wealth before and after the acquisition by calculating the percentage change in equity value and next year's dividend income for both of the company's shareholders. 6 marks. Yes. Next. The next point is advise the board any concern that the company may have with the acquisition and discuss the validity of the assumptions made in evaluating the proposal in B1, 2, 3. Yes. Concern and assumptions. 8 marks. the concern of the board, and validity of assumptions. Discuss the credibility of CEO's alternative suggestions to use a share buyback as a takeover defense and advise whether or not it is a feasible strategy for Joshua Company, 5 marks. So there are so many requirements. You see, 1, 2, 3, 4, 5, 6. 6 requirements are there. 6 main, and I think there are 8, 9 sub requirements are also there. So such question is easy to handle. Yeah, you can, because small parts are there. So we will start reading it, reading the requirement once again. Agency problem. So theoretical part, I will be solving at the end. First of all, we will be solving the post-acquisition WACC. So Joshua Company. So let us read it. Joshua is a listed leading fashion retailer with the stores based in flagship retail centers nationwide. For many years, Joshua Company has been highly popular, but its financial performance has suffered recently due to the problem associated with its online operations. These problems are causing concern for the company's institutional shareholders. Online rivals have emerged in recent years and are quickly reducing Joshua Company's market share. These companies have also successfully diversified into other areas such as household furnishings once they have established a well-known brand. Joshua Company recently attempted to acquire one of these online rivals, Fraser Company, but neither company's shareholders approved the deal on the ground that it was unlikely to create value. Now, following a series of profit warnings, there has been ongoing media speculation that Joshua Company is attracting takeover interest. There has been no approach made so far, but the Joshua Company's directors are concerned about the applications for their future in the company. Joshua Company's chairman would like to discuss defense strategies at an upcoming board meeting, particularly the suggestion that Joshua could defend itself against a takeover by improving its takeover offer for Fraser Company. The rationale for this result would be much more difficult to acquire and enlarge Joshua. Now, so in addition, this would also introduce a risk diversity and benefit. Now you see here, the point is, so this is the Fraser Company. Okay, they say unlikely to create value. It is facing online issues. So this data, this information should be grasped. And they say that if they acquire, yeah, so here it is, risk diversification. Now, so next, let us proceed further. So acquisition. Joshua Company's funding options have deteriorated significantly since last year's cash offer. For Fraser Company, was rejected. It no longer has the cash reserves acquired to fund another cash offer. And the shareholder are likely to agree to a right issue as soon as after the last attempt, which are also ended in failure. That in addition, Joshua companies gearing significantly exceed the industry average, and company is close to breaching one of the bank covenant. The CEO has therefore suggested now a new offer should be based on share for share exchange. So just keep the requirement in your mind. Post acquisition WACC, additional value to the shareholder of Joshua, and wealth before and after the acquisition by percentage change in equity. So this is what should be kept in mind. The following information is available, including brief extracts from both companies' most recent annual reports. Market value of equity, asset beta, dividends, and ordinary shares. Cost of Joshua's post-acquisition beta can be assumed. This is very important now. The first requirement. Weighted average of both companies' pre-acquisition asset beta, weighted in proportion to their market value of equity, asset beta. The board intend to maintain debt equity ratio and expect the pre-tax credit spread on its debt remain at 410 basis points above the risk-free rate if really required. Now we have to calculate post-act WACC, and all the data is available in this one paragraph. The whole data is available. It is very easy. In my opinion, this is the easiest question, which is 5 mark, can be scored. Let me open the Excel sheet and solve it. So, Joshua company, we are doing so post the it is B part, appendix 1, yes, and B part, B is first part. Post acquisition WACC. Now they say that beta asset. So beta asset. They say post acquisition beta asset can be assumed to be a weighted average of pre-acquisition asset beta weighted in proportion to market value of equity. So what is the total market? Yes, you see here. 0.85 into 1 or 2. Right? Divided by total equity. 1 or 2 plus equity of Fraser as well. Proportion to total. 102 divided by total equity. Equity of this divided by total equity. And plus asset beta 1.18 into 56 divided by 102 plus 56. weighted. So what they have told that, this is assumption as well. They say in the next part, they say, discuss the assumptions as well. Okay, yes. So 0.97 is the beta asset. 0.97 is the beta asset. Next. So the next point is beta equity. Now they say post-ac debt equity, post-acquisition debt capital structure, debt equity. What is they say? They say it will be 30-70. Yes. And what is the tax rate? Tax rate we need to check. What is the tax rate? 18%. 18%. Now, so equity beta, we will be using re-gearing formula of asset beta. We need to calculate, if you remember the formula, beta asset is equal to beta equity into equity over debt plus, equity plus debt into 1 minus tax rate. So this is the basically formula which we'll be using to calculate beta equity. We need beta equity. So it will multiply the other side. So beta equity is equal to beta asset into denominator will go the other side and get multiplied. So equity 70 plus debt 30 into 1 minus tax rate. Yes, divided by, again, equity. I have applied this formula. So beta equity is here, 1.31. Yes. You can see the calculation. The next point is cost of equity. So cost of equity is risk-free rate 3.7% and risk premium is 8.1% plus 8.1% into equity beta. Yes. So capital asset pricing model. The formula is, we know that I have applied the formula that is equal to risk-free rate plus beta equity into equity risk premium. Here you go. This is what I applied. Now, they said that the cost of debt is 410 basis point above the risk-free rate. Risk-free rate is 3.7%. So cost of debt 3.7% plus 4.1%. 410 basis point. It is a pre-tax cost of debt. 410 basis point above the risk-free rate. 4.1% above. So now WACC we can calculate. Weighted average cost of capital. WACC equal to cost of equity into equity 70%, 0.7, 70% weightage in the debt equity. Okay, 0.70 plus 30% of is the debt. Cost of debt 7.8% into 1 minus tax rate. 1 minus tax rate. Here you go. Now, so this is done. WACC is calculated. We can say that this is equal to 12%. Yes. Now, the next requirement. The next requirement is additional value to shareholder from Joshua Company's post-acquisition of Fraser Company. Yes. Here is the post-acquisition cash flows. They say, according to the finance director's forecast, Joshua will earn profit before interest and tax of this in the first year after the acquisition, growing by 5% per year in the following 3 years. Post-acquisition, right? It is assumed that the tax liability will be equivalent to the amount of investment needed to maintain. What does it mean? This sentence means that we need not to be worried that here profit is given, so we have to add back depreciation. This sentence means that it is automatically adjusted. So here PBIT is equal to cash flow as well. This sentence means profit is equal to cash flow. However, investment in asset of $2.7 million will be in the year 1, and then, yes, 2.13, I'm sorry. Okay. Per dollar increase PBIT from the year 2 to 4. Okay, we'll see. It is expected that equity will create after-tax synergies worth 9.2 million per year in each of the first 4 years. From year 5 onwards, the company's free cash flows are expected to grow by 3% for the foreseeable future. Now, it is very easy. So, students, so what is the additional value created for Joshua? Yes. Let us start doing it. So, Appendix 2. Additional value estimation. Yes. So you see here, year 1, 2, 3, and 4. So profit before interest and tax, they have given us. It is in the first year, 27.2 million. Then 5% increase. This into 1.05. Then 5% increase. Yes. Next. Okay. So students, now we have to pay tax. That is 18%. We know that. Equal to minus 0.18 into this. Here is the tax. Here is the tax payment. Yes. Next. The next is, they say increment capital expenditures, incremental capex. Investment of 2.7 million required in year 1. So incremental capex, 2.7 million. And then 2.13 per dollar increase in PBIT. 2.13 per dollar increase in profit before interest and tax. So this minus this into 2.13. You see here, what is the increasing amount, number, and per dollar increase? 2.89. Yes, 9. And it is negative figure because it is investment, additional fund we have to invest. What is increase in the profit? And for each dollar increase, his profit is financed by $2.13 per investment. And same will be applied here. You just have to draft one-time formula. This is the beauty of this calculation in Excel. Now, yes, I hope it is clear so far. So, any other cash flow? No other cash flow. This says synergies are there in each of the first 4 years. Okay, 9 million. Right? Synergies are 4 years. From year 5, the company's free cash flows are expected to grow by 3% in the foreseeable future. Okay, right. So these are the free cash flows. These are the free cash flows. They say they are expected to grow afterwards, will grow at 3% per year. For the foreseeable future. Now, the next point is present value we have to calculate. But they say that what is the discount rate? Post-tax VAT we have already calculated. So present value at the rate of 12%. This into 1.12 raised to power minus this. So post-tax WACC, present value, we have calculated at that. So present value from year 1 to 4. Here you go. Now, present value from year 5 onward. Year 5 onwards, it will grow at 3% per year. So equal to, so student, it is perpetuity with growth and deferred perpetuity with growth. So present value is calculated like CF1 divided by R minus G. This is perpetuity with growth formula, simple perpetuity with growth. It is delayed as well. So discount rate will also be multiplied. Delayed perpetuity with growth. So CF1 is not available. Cash flow in the year 5 is not available. We have to calculate. So where CF1 is equal to CF0 into 1 plus G. It will be replaced by that. Yes. So the formula will become present value is equal to CF0 into 1 plus G over R minus G into 1 plus R raised to power. This is discount rate. This is the formula which will apply here, which I will implement here. So CF0 is 22.6 into 1 plus G, growth rate 3%, over R 12%, discount rate minus 3%. Multiplied by 1 plus R raised to power minus 4. Discount rate, 4-year discount rate. That will be applied. So this is the present value from year 4, beyond year 4. From year 5 onward. One thing remaining, that is present value of synergy, which is for 4 years. 9 million, they said 9 million each year, 9.2 million. And we will apply with annuity factor for 4 years at 12% in exam. Here is the point. Yes. Annuity factor, here is annuity table. 9% for 4 years, 3.24. 3 point. Sorry, it is at 12%. The discount rate is 12%. I'm sorry, 9%, what I'm saying. Yeah, 3.037. Discount rate is 12%. 3.037. 3.307. Here it is. So total value of company. Company's total value. Here you go. Value of company. Now, market value of equity. That is 70% of it. This into 70%. What? Because 70/30 is the debt. 70/30 is the debt. That equity. Student, the requirement is additional value to the shareholders of Joshua Company, proposed acquisition of Fraser Company. So they purchased the full equity of Fraser. How much is their current equity of the both? So additional value created will be like this, equity. So just see here, additional value of equity, because this is the revised value. What was the previous value? 102 and 56. So here it is, 23 million. Yes. 23 million. That is the additional value of equity created. It was the answer which was required. Yes. Here it is. So the next question is, the next question is a bit technical. Compare the shareholders' wealth before and after the acquisition. By calculating the percentage change in equity values and next year dividend for both companies' shareholders. Yeah. So students, you see here, share for share exchange. The CEO proposal for share will involve one Fraser share being exchanged for 3 Joshua shares based on the last year negotiations. The board believes it has good understanding of Fraser company's expectation. You have been asked to include minimum acquisition premium of 35% into your analysis. The same premium which was requested last year. Fraser founder majority are unlikely to approve and share offer on terms which would lead a reduction in the annual dividend. However, their debt include Joshua covenant restricting now 25% of each year cash flow to firm. Very technical issue now. The board has therefore asked to an evaluation of the impact of the proposed term on the next year forecast post acquisition dividend for the both companies. Now the point is, first of all, shares. So the third appendix 3. Impact on shareholders' wealth. Yes. Now, so two companies are there, Joshua and Fraser. We have to compare their current equity and revised equity. Both values. Percentage change we have to calculate. Current dividend, revised dividend, percentage change. Okay. And for that purpose, we need to do some working. I will do the working here. So the first working is how many shares will be issued to Fraser Company. So number of shares to be issued to Fraser Company. So you see here, Fraser Company has in issue shares $10 million each share. Right? And they say for 1 share of Fraser, 3 shares of Joshua will issue. Yes. So 10 million into 1, 3 by 1. For 1 share, 3 shares of Joshua will be issued. Number of shares to be issued to the Fraser Company. Now, Joshua, how many shares it has total? Before 40 million. Now, so total number of shares in issue by Joshua, 40 million existing, 30 million additional, 40 current, 30 additional, 70 million in millions. It is in millions. Now, so students, yes, just come here. Joshua and Fraser. Current or pre-acquisition wealth. Pre-acquisition wealth or equity value. Better word is equity value. So their current equity value is 102 million and it is 56 million. Yes. The next is when they acquire it, post-acquisition, it is the number of shares, 30 and 70 million. Total shares are here. And market value of equity, we have calculated post-acquisition. We have already calculated of Joshua. That is above 180 million, 1 million. You see, we have calculated that total market value. So post-acquisition equity value. Just see here. Joshua will have 40 million shares. Its current shareholders. 40 million. The same will be there. 40 divided by 70. Total are 70 into this. This is the worth they get. And here 30 divided by 70. into this. This is the worth they will get. Yes. This is the worth they will get. They will have 30 shares, yes, 30 million, and they will have this value. So percentage change in equity value, percentage change, this minus this divided by this initial equity change in percentage around 1.4%. And here you go, 38.5%. How I calculated percentage change? Just see. Next. So the first part is done. That what is the percentage change in dividend? So, students, now dividend is a bit tricky. Come here. The dividend, they say, in the first year, what is the, 19.6 is the available cash in the first year which they can pay after acquisition. 19.6. Right? This is the total cash flow. So they say there is a covenant restriction that they can pay how much dividend? 25% of each year cash flow. So the another working. We will be doing working. Yes. So dividend, working for dividend. Okay. So maximum dividend can be paid in year one. Paid in year one. Student, how much? 19.6 into 25%. This is the loan covenant requires. 4.90 million. So dividend per share. This divided by total shares. It is 0.707. Yes, 0.07 per share. So now come here. What is dividend current being paid? Now you see here. So we have to calculate. Dividend, currently dividend being paid is here. So dividend currently being paid. Yes. That is equal to 2.7 million and 3.2 million. Okay. Now, revised dividend, post acquisition dividend. Now focus, everyone. They have 40 million shares into this. This is the revised dividend, per share dividend. Okay. And it has 30 million shares. This one into this 2.10. So percentage change. So percentage change. Yes. This minus this divided by this. Oh, divided by this. Change. Yes. There is negative, decreased dividend. 34.4%. There is increased. Students, now we have to comment on it. And you see here, what were the conditions? We have met some conditions. They say that 35% premium on the equity value, it is met. It is more than that. But dividend reduction, so annual dividend has reduced. Annual dividend has reduced by 34.4%. Any calculation which is not clear, you can ask the question. Any point which is not clear yet. So, yes, premium on equity is more than 35% required by Fraser Company. Yes. While dividend has reduced by 34.4% in first year. It has reduced. Now, students, we have to discuss now. Calculation is complete. Yes. The question name is Joshua. Let me save it first. Past exam is June 2023. Yes. So now we have to do the discussion. Word document I will open so that we can start doing the discussion. Students, advise the board of concerns. Either company shareholders have with the acquisition and discuss the validity of assumptions used. 4. We have to create a report. Okay, in the report, this is the first. And credibility of CEO's alternative suggestion. This one, we have not read this yet. We have not read this yet. So, students, let us proceed further and start discussing it. So basically, it is the B part. A part we have yet to do. So report to the board of Joshua Company regarding acquisition of Fraser Company. Report. Students, first of all, introduction paragraph, we know that is there. So introduction paragraph. Yes. This report evaluates the proposal to acquire the Fraser Company by Joshua Company in terms of the effect on additional value created. This is the first requirement. First requirement. This is the first requirement. Additional value created. Yes. Yes. Additional value created. Yeah. Change in wealth of the both companies, shareholders, and effect on the dividends. Moreover, moreover, any concerns of the either company shareholders, yes, of the any concern of the shareholders which are likely to be raised have been discussed of the either company shareholders have been discussed along with the assessment of validity of assumptions used in the calculations. Yes. Now, next, discuss the credibility. Yes. And lastly, CEO's alternative strategy to buy back to of a share buyback as a defense against takeover has been discussed. Yes. So you see here, we have discussed all these points. Now, which has to be discussed in the report. So, now, the following are the results derived from appendices. Appendices. Yeah. Now, students, the one is, so we have to calculate, just see here. What we do is, I will add a table here. Yes. Joshua Company and Fraser Company. So equity change, dividend income change. Yes. Income change. So that is here. The change is 1.4% and 38.5%. 38.5%. Dividend income changed. It is 3.7 and 34.4. Students, we have to discuss are the summary results. Now, although the company acquisition is creating additional value for the shareholders of both companies, and for Fraser Company, it is 38.5% above than the required by their current shareholders. But the dividend is reducing, and thereby making the acquisition doubtful. Yes, doubtful. So, students, so we have discussed the first three parts. Now, shareholders, yes. So shareholders concerned, and the other is assumptions used. How many marks it bears? It is 8 marks. Concern of the shareholders. So fourth is shareholders concerns. Now, students, once again, cash offer was rejected. Okay, before, and it is already close to breaching the bank covenant. Yes. So the point is, Joshua Company's previous offer, cash offer to buy, to buy yes, to buy the Fraser shares was rejected due to lack of cash resources previously. Previously. So now, again, it is creating a small value for shareholders of Joshua Company. Again, small value. And they will be losing their current voting rights, voting power, not right, voting power, as a large number of shares will be issued to Fraser Company. Yes. So one by one, both shareholders. We have to talk about the shareholders of both companies. So first of all, Joshua we are talking about. So under although dividend are also likely to improve by a small amount. Yes, but still keeping an overall assessment of the fact that Joshua shareholders may not approve this offer. Yes, small improvement in the wealth. They may not. So now So shareholder Joshua, now the Fraser Company. Fraser Company shareholders were getting 35% premium on cash offer previously. And now they are getting 38.5% in share for share exchange. Share for share exchange. Which is not that much. So not having that much attraction in monetary terms. Monetary terms. Furthermore, dividend is decreasing by a large percentage of 34.4%. And what they said, majority shareholder. So, which is the major concern of a majority shareholder of Fraser Company. Fraser Company. Now, and they may not approve this offer. Yes. So it is done. So 4 marks. We have written for 4 marks. Now, so 4 marks for shareholder, 2 marks for this, 2 marks for this. Now the next is 1 valid point, 1 mark. Assumptions used in the calculations. Now start recalling the assumptions. First of all the data given, it is accurate. Profit before interest and tax. There is investment, capital, incremental investment, tax rate, synergies. Okay, they are accurate, and these are constant. Okay, so assumptions. So it is assumed that profit before interest and tax, incremental capital expenditure, and synergies are accurate estimate. They're accurate estimate of the cash flows. It's accurate of the cash flows. Moreover, cost of capital of the post-acquisition company is based on multiple assumptions of weighted asset betas as per pre-acquisition market values of equity. Yes. And it is assumed that this cost of capital and capital structure will remain constant. Will remain constant. Any change in all these variables will have impact on the values of equity calculated for shareholders of both companies. So, a sensitivity analysis and scenario analysis should be performed. Should be performed. Now, yes, students, the growth rate. Yes, the post-acquisition valuation is based on the assumption that free cash flows will grow at constant rate in the foreseeable future. In the foreseeable future, and at, which is not a prudent estimate. Yes, and it may not happen and may not occur. Yes. Lastly, the synergies of 9.1 million or 2 million has been estimated without any explanation that how they will arise. So these need to be thoroughly investigated. Yes, as they form a material part of post-acquisition value of company. How much it was? 181 million. Yes. So it is done. 4 and 4, 8. You see, these assumptions are the easiest thing to be written about. And it is normally present almost in all questions of valuations, investment appraisals, they are present. And the first shareholder is concerned. I have not written anything technical. Just see what I have studied through the scenario and my calculation. I have explained that only. Now, the next is, yes, the next part, share buyback. Students, just give me a 5 minutes. Okay, you just go through it and I'll be back in 5 minutes and I will continue. 5 minutes only. So, students, now, as yet there has been no formal takeover offers for Joshua Company. However, the board wants to fully prepare in case this changes, particularly if their own takeover of Fraser is not viable. The director have been attending a series of seminars on alternative takeovers, defense, and likely to discuss their finding at next week's board meeting. The topic to be discussed including the possibility of using a share buyback as a defense tactics. This would involve Joshua Company buying and then canceling some of its own shares. Joshua Company's share have asked for advice. Company CEO has asked for advice as the credit such a defense would like to discuss the effect on company's EPS. Oh, good. So they have given the data to us of which we can discuss now. Only 5 marks. Very easy. So, effect on this. Liquidity problem, a further bank covenant. What asset can be disposed of? Now, students, feasibility. Let us start discussing it. So, defense strategy, share buyback as a fifth part. Share buyback. As a defense against takeover. Now, students, share buyback. They themselves have given the whole idea what to discuss. Everything is here. So you see here, this is very good thing. That answer is present in the question if you can think a bit more, yeah, critically. So share buyback will reduce the total number of shares in issue. In issue, it will reduce. And as profit will remain the same, its EPS will increase. It will increase. EPS will increase. And earning per share. And yes. What will happen? The company will move closer to its optimal gearing level. Yes. And cost of capital will decrease overall. When they have optimal capital structure, appropriate mix of debt and equity. So cost of capital will decrease overall. So increase in EPS and decrease in cost of capital. Capital will lead, will lead an increase in share price, which will discourage any takeover attempt. Any takeover attempt. Now, moreover, since there will be lesser number of share holders, it will be difficult for the acquirer to buy the number of shares to have a controlling interest. How many marks? 2 marks. Around 3 marks we have written. 3 points we have made. For 5 marks we have to write. So means 5 valid points. So, students, the next is, on the other hand, this share buyback may be interpreted as an attack by the market that company lacks investment opportunities. And it may reduce its share price further. Yes. Now, students, the last point. Liquidity problem. Loan covenant. This has to be considered. So share buyback will require cash outflow and we have studied already. Yes, because they don't have cash. They rejected. Cash reserves are not required. And Joshua company is already having low cash reserves. Okay. Moreover, if they dispose of any asset to raise cash for the same purpose, but yes, it may affect their operations negatively in future when they don't have assets. Now, so students, we have discussed, already have, look at result. So the point is share buyback, credibility, whether or not it is a feasible strategy. Yes. So whether it is feasible or not, the final word we have to say. So the point is, share buyback may deter the any takeover attempt if it is financed, but finance is needed for this strategy. The company needs to investigate the sources of funds availability, and if they are arranged, then buyback should be done with proper communication to avoid any downside risk attached with it. Yes. For example, communication can be done to the shareholder. That's why we are buying back. Next. Students, the last paragraph, since it is a report conclusion regarding the whole acquisition. So we have to say the same, but with a few words. We have to wrap up everything. Now, so the acquisition of Fraser is not having attraction for shareholders of Joshua Company, but it meets one demand of premium on shares of shareholders of Fraser Company. Again, their expectations of dividends is not being met. So they may reject it. This offer. So the alternative defense strategy proposed by, so proposed by, who proposed that? Who proposed that? CEO's alternative suggestion. But the CEO does not seem to be financially viable due to lack of cash resources of company. Simple as that. So whatever we have done above, that one conclusion paragraph we have added. So this is also done. Now this question has only one part which we have not done. That is the first part. Yes. Everything else is done. Send your question to all, dear. Send your question to all. I will respond your question then. Listen. If allocated time of any question part is done, leave that part and move to the next. I'm not saying the full question. I am further coming down to the part level management. If allocated time, for example, this question we are doing, here it is. Yes. We are doing the question 11 marks, additional value. How much time it has? 11 into 1.8, 1.8 minute per mark. Around it will be 20 minutes, for example, 18, 20 minutes. It should be completed. Yes, time is saved from the question like assumptions when you are writing. Concern you, this can be saved from this. You have, yes, around 11 minutes for it. Okay, but I would suggest write this one, sorry, 8 marks. You have 13 minutes for it. If you can save, you should save time from it and complete it quickly. Remember, in exam, you cannot sit and stuck on one part. You have to manage your paper holistically. I'm saying holistically, bigger picture. Students are stuck in one part and they spend majority time there. Please do not do that. Okay, do not do that. Where a part is incomplete and time is up, leave it there, move to the next. I hope I have given your answer to your question. Yeah, welcome. Now, this is the first part. So students, this question is about this part. Yes. The question is, sorry. Yeah, here it is. Discuss the agency problem created by Joshua's proposed takeover of Fraser as a defense. Okay, discuss the agency problem created by this and risk diversification strategy. and explain how this could be mitigated. Now, how this could be mitigated. So basically, if we say there are two major parts, the first, agency problems created by them, these two things, and explain how agency problem could be mitigated. 5 marks, 5 valid points. So come here. This is risk diversification. What is risk diversification? That the company invests in different businesses. So let us discuss it, its answer. So the A part, agency problems. Yes. What is the agency problem? So the company interest, company's interest, and its board interest conflict with each are, yes, have conflict with each other normally while an acquisition is taking place. Yes. Same is the case with Joshua and its board of directors. Now, so as directors fear that they will lose their job following the takeover. Following the takeover. And they make decisions to protect themselves rather than protecting the interest of shareholders. So they might be portraying that they are using defense against the any takeover offer in the best interest of shareholders. Yes. But in fact, they might be protecting their own job, right? So in the case of Joshua, using takeover of, using Fraser takeover as a defense against its own takeover. Takeover. If is it is yeah if is maximizing shareholders wealth or not, or not. That should be evaluated. Simple as that. Agency problem and conflict of interest. No, risk diversification. So risk diversification strategy. Secondly, in the risk diversification, risk diversification strategy of any company is, any large company is normally seen as directors protecting themselves as shareholders are already well diversified. They're all well diversified in their investments. So they don't want the companies to make investment in diversified portfolios, businesses. Now, I will explain it. You know that. I am an investor. I purchased the share of an IT company. On the other hand, I have purchased the share of a food company, a furniture company. I have well diversified portfolio. Now, the IT company itself, they start investing in and start opening their other businesses that we will diversify. I said, no, sorry, you should not diversify. I have invested in an IT company. Why you are diversifying? I have myself diversified. So the company need not to be diversified. Company need not to be diversified. Yes. So mitigation. So this is how it with this agency now. Conflict of interest. So how this agency relationship. Yes. The next requirement, I just want to show you the requirement. How these could be mitigated. Agency problems. How could these be mitigated? In all this process now. What is it going on? So mitigation now. So directors must have to satisfy shareholders of Joshua that take over defense strategy that how defense strategy will be in the beneficial interest of shareholders. They have to do that. And all the concerns of shareholders should be satisfied. The sources of synergy in the case of Fraser Company should be thoroughly investigated and how the board intends to realize those synergy. Any practical plan should be shared with the shareholders. Now, so that's it. That's the end of it. So then it is done. So it is the question, Joshua Company, yes. June 2023, question 1. It is completed. The question is done. So, students, the next question. Second question of the same past paper. Again, acquisition strategy. Again, it is on merger and acquisition. Similar question. Discuss the non-executive director views in relation to Oxwick Company's acquisition strategy and acquisition of Ludham Company. Estimate using the data available the equity value of combination of both and percentage gain in the value they would gain by the Oxwick shareholders from acquisition, concluding whether it will fulfill the expected requirement of 15% gain in value or not. 10 marks. Discuss the assumption in part B. Similar question. Students, yes, please open it and I want you to read it carefully. Yes. Please, requirements. Do you need a break or should I proceed with the question? Will you need a short break of 10 minutes or should I proceed? Tell me. Tell me frankly. You people are on silent mode, I think. Please respond my question. Ask something. Okay, right. So it is a 10 minutes break. 10 minutes, we'll be back and we will continue. Yes, students, now. So I'll be opening a Word document. Yes. Discuss the views of the non-executive director's views in relation to Oxwick Company's acquisition strategy. Yes. So acquisition strategy and acquisition of Ludam Company. To discuss that. 5 marks. Oxwick Company is a listed fruit flavored, software manufacturer, which soft drink manufacturer, which has increased its profit significantly over the last few years and is looking to expand. Oxwick Company's directors have identified Ludam as potential target, right? They have identified Ludam as potential target. Now, the next. Ludam is an unlisted for family-owned company. It produces a premium of brand of soft drinks. The the Ludo, I don't know what is the name, chart brands. The Oxwick company is that aware that the brand is stocked with a number of retail outlets where Oxwick company's drinks are not stocked. Very important. Okay. Assuming Ludam is acquired, Oxwick company's director believes that Oxwick will be able to spend more marketing the brand than the Ludam have been able to spend. Right. Increasing sales significantly, it also achieves other synergy to increase the value and justify the acquisition. Or one of the Oxwick owners believes that acquisition will be of no value to Oxwick because it does not reduce risk. He feels that Oxwick company should want the company to make acquisition which reduce risk and therefore increase company value. He believes that Oxwick company should therefore consider acquiring other company with different stream or no more or one or more of its supplier. Wonderful. The similar discussion which we have done in the last question. So non-executive directors' views we have to discuss. Right. As per non-executive director, shareholder want the company to reduce its risk through acquisition. Through acquisition. Yeah. By offering by acquisition of those companies who offer different products. This is the first part of the sentence. What non-executive director has said. Let me copy it from here to the word. It will be easy. Yeah. Over different product. Different products. This diversification of the business reduces the risk of business. Stabilizes its earning and make its cash flows more predictable. Because when you have different earning stream, a company, so risk is minimized. But and hence value of share may increase. But in fact, majority shareholders don't want company to be diversified. Yeah. As shareholders are themselves diversified. So they may dislike this decision, discourage such decisions by the company, by Oxwick company. Moreover, the management of Oxwick may not be experienced in managing other products and inefficiencies in the business may arise. And inefficiencies in the business may arise. Yes. Leading to decrease in cash flow and profitability. So one aspects, they say acquire other company with a different product stream. So we have discussed that. So the first point is diversification of business. The first point. It has, I think, 5 marks. Yes. By the way, we have written for 2 marks at least. At least 2 marks. At least. You may get 3. So they say acquire one or more of its suppliers. So the next is acquisition of supplier. Now, Ludham company as well. The current argument. Acquisition strategy and acquisition of Ludham. So the other view, acquisition of supplier. Student, we must have to touch all three parts of the question. This question analysis is that we have to director's view, one part, the other part is acquisition of Ludham. Two parts are there. 5 marks. So it means we have written more than required here already. Only 2 valid points were enough. Acquisition of supplier. So buying a supplier company is a backward integration of business. Yes, it will reduce the cost of its raw material, and hence and ensure supply of the raw material. Yes, ensure. Now, so students, but again, the management, but on the other hand, if on the other hand, Oxwick company can ask and research the market to get best prices. This option they will lose if they acquire their own supplier. So both sides discuss. Next, acquisition of Ludham. They are producing the same product, drinks. Yeah, they have more outlets in the market. So we have discussed this. We have to discuss these points. Ludham company. So Ludham company is doing the same business as that of Oxwick company. And having some outlets, its own outlets as well. Through which Oxwick can sell its own products as well. Moreover, yes, you see here, Oxwick can spend more on marketing of this brand, Ludo Chart brand, to increase sales. Yes, to increase sales. Yeah. So hence, synergies will be realized. Yes. Now, through this acquisition, economies of scale will be achieved being in the same business. And having larger customer base, being a larger company, will benefit the Oxwick in multiple financial aspects. Yes. Enough. I can write much more about it. For example, it will increase their asset base. Their, if I say, let me tell you only, it is not to be written because marks are a few. They can negotiate better funds, better negotiate with supplier. This is scale of operations. So it will benefit to them, actually. Now, the next point is the next question. Yes. Equity value of combination of Oxwick and Ludam, and percentage gain in values which would be gained by Oxwick company's shareholder from the acquisition. Yes. Come here. Equity value. Now, Ludam company's profits have remained static during the past 3 years, as it is an unlisted company. It is an unlisted company. There is no information about Ludam company's forecast cash flow. Okay. Forecast cash flow not available. Oxwick has 200 million shares in issue, and its current market price is this. Its most recent post-tax earnings are here. Now, Ludam company has 80 million shares in issue. Its most recent post-tax earnings are this. Assuming that Ludam's current valuation can be obtained by using Oxwick's P ratio reduced by 40% to Ludam company's unlisted status. Yes. Now, the post-tax cash flow for the first year of combination estimate to be 270 million. They are expected to increase by the following percentage as a result of sale volume increase, synergies, and inflations. Tax allowable deduction is assumed to be equivalent to the amount of investment needed to maintain. Again, life is easy. Additional investment is required. 28 million end of year one. Additional $0.8 for each $1 increase in post-tax cash flows. After 4 years, the annual growth of free cash flow is 5%. No additional capital investment after 5 years. Now, the combined company's cost of capital is this. It is expected that it is expected that combined company's debt to equity will be 2080 market value terms. Yes. It is assumed that shareholder of Ludam will require a 15% premium on fair value of their share to satisfy their own shareholders. Oxford's director believes that it will result in a minimum gain to their 15%. Yes. Oxwick as well. Now, so let us start with the equity value of combination of the both. Equity value of the combination of the both. Now, so let us start with it. Combined company. I will open the Excel sheet. Yes. Yes. The company name is Oxwick Company. It's B part we are going to do. That is related to equity value of combination. The first one is of combination. Yes. Students, we will be, yes. Here we are. So here the post-tax cash flows for the first year, 1, 2, 3, 4. It is 270 million with increase by 1.12. This into 1.1. This into 1.07. These are the post-tax cash flows. Post-tax cash flows. Now, what is the adjustment? Adjustment is CapEx. Capital expenditure. Incremental CapEx. So that is equal to 28 here. Then additional is this minus is increase into 0.8 and negative. $0.8 for $1 increase in post-tax cash flows. You can check it. The formula. So CapEx is done. Now we can calculate free cash flows. We can calculate free cash flows. Here we are. Here we are. So now they say combined company is cast off. And after that 5%, okay, for year from year 5 onwards. We will do that, don't you worry. So present value at the rate of 12%. this into 1.12 raised to power minus this. So present value of cash flows from year 1 to 4. Sum from here to here. Present value of cash flows from year 5 onwards. The next point is, they say that these will increase at 5%, 1 plus 0.05. I'm not explaining the same logic again and again. It is perpetuity with growth over R minus G, 12% minus 5% into 5-year discount, 5% discount factor for year 4. This is perpetuity with growth and then discount factor. Yes, here multiplication sign missing. One 1.05 into sorry, this discount rate is 12%. Yes, 12% discount rate. Yes. Now, discount rate is 12%. Now, the next is combined company's total value of combined company. Combined company, that is equal to this plus this. 4085. Just let me check the calculations once again. Yes, that's okay. 337 into 1.05. Right. Okay. So the total is, sum is here. 4085. And now they are saying 80% is the value of equity, combined company. Yes. Value of equity. This into 80%. Yes. Now, okay, this is what I was thinking. There will be no capital investment from year 5. So, student, we have to grow not this amount. We have to grow this amount. In year 5, there will be no capital investment additional. Okay? So, this will be the free cash flow. That's what I was missing. Yes. No additional capital investment. In exam, it may happen. Just like I missed. How many marks you will lose? Maximum 1 mark. Maximum 1 mark. Continuing error marks are not deducted. Remember that. So value of equity is here. So students, the requirement that we have done, we have calculated value of equity. Percentage gain the shareholders will gain of the most shareholders. We will see. So first of all, we need to calculate their current worth. Value of equity of combined company. Now, let us proceed. So, second part, we have to calculate percentage gain of in equity of both. We need to calculate that. So, first of all, one by one, what is current status? Oxwick company current market value of equity. Yes. Current market value of equity. That is 200 million shares with 11.52. This is in millions. Yes. Market value of equity. Post-tax earning 128 million. Right? Current. Now, come to the other, Ludam. 80 million shares. And they say its PE ratio is 40% of Oxwick. So PE ratio of Oxwick, price over earning, 18. Current PE ratio. So PE ratio of Ludam, it is reduced by 40%. This into 0.6. Reduced by 40%. Ludam company. The next is earning. Current earning of Ludam company is 52 million. So market value of Ludam company currently, so PE ratio into earning. PE ratio into earning. How market value of equity, how it is calculated? We know that. PE ratio into earning. That is the market. This is what I have done. So current market values we have calculated. Right? Now, so they say they want at least 15% shareholders of Ludam require 15% premium on their shares. Okay. So price including premium required by Ludam company shareholders 15%. This into 15%. This is the premium they want. Right? This is the premium they want. Now listen, focus everyone. Now, total gain in combined company for Oxwick company shareholders. We need to calculate that. Combined company total value minus their current values minus gain required by them. Total value post-tax minus their current values minus premium required by Ludam company shareholders. Okay. You can calculate it another way as well. Yes. So 461 million. You can do 1.15 at total with premium. So this is the gain for them. So percentage gain for Oxwick company shareholders. How much percentage they got? They got 15%. You know that. This is what they got. Current one, which is 20%. 20%. So the requirement is the directive assume that Ludam will get a 15% and their own should also minimum 15%. So after payment of 15% premium to shareholders of Ludam company, Oxwick company shareholders will get 20% gain. Yeah, which is more than required minimum of 15%. So, acquisition will be acceptable to the shareholders of So it will be acceptable to the shareholders of Oxwick Company. Now it is done. Yes. Discuss the assumptions. Assumptions. The first assumption is 40% P ratio reduction, listed to unlisted. The first assumption is that we valued the Ludam company's shares at 40% of the P ratio of Oxwick company, whether it is suitable or not. That need to be considered. Might be inaccurate judgment. And the equity valuation of combined company, they have given, that is based on a certain percentage growth. And on which basis it has been calculated, they're not clear that whether these synergies are there, cost reduction is there, whether they are realizable or not. And then 5% growth in perpetuity, whether it is achievable or not. Yes. And no investment required, additional investment. Now, so we will be talking about it. Let me type it so that we can have this written answer with us. So assumptions. So C part. Students, when we are raising the questions on assumptions, it is basically professional skepticism. Assumptions. Discussion on assumption. Yes. Now, first of all, in the valuation of Ludam company, P/E ratio of Oxwick has been used and reduced by 40%, and yes, 40%, for the sake of making it appropriate for an unlisted company. This was a purpose. How this 40% reduction has been calculated is questionable. Is questionable. And it may not be, now you see here, have been static. Ludam's profit have been static. So this is questionable further, especially when Ludam is not has static profit, while Oxwick is growing. It might be. So this reduction may be erroneous, means, yes, erroneous mean include errors. Second point. So valuation, we are talking about combined company. Moreover, next line, moreover, the valuation of combined company depends upon cash flows forecasted, and there is a significant growth projected in first 4 years. 4 years. And you see here, no information available of cash flow forecast. And without availability of cash flow forecast of Ludam company, such a cash flows of combined company are questionable. Yes, questionable, and may not be accurate, especially from year 5 onwards. A 5% growth in the foreseeable future is a high annual growth. Yes. And should be critically evaluated and investigated. Yes. Lastly, it was assumed that there will be no capital expenditure required after year 4, which is inaccurate assumption. given the fact that business cannot survive forever without additional capital expenditure. One more thing, they have given us this cost of capital 12%. Yes, lastly, moreover, lastly, here it is. Lastly, cost of capital is same, assumed to be same for the future, and there is no information how it has been calculated for the combined company. So these are the assumptions for 5 marks. If I say 1, 2, 3, 4, and 5, done. 5 marks for 5 assumptions discussion. It is complete. Now, so this is also done. 2 questions done. Third one, Black Bosca Company. The third question of the same past paper. I will continue this past paper. Let us try to complete it. If we can today. Evaluate the suitability of investment proposal in Uzbekistan, including in your analysis a discussion of chief executive officers concerned about consultants' cash flow. Now you have to do the discussion as well on the chief executive discussion. 5 marks for discussion, 8 marks for calculation. Right. Discuss the financial and business risks which they will be exposed to if project is approved. Financial and business risk related to the project. Wonderful. Now, B company is the market leading online food delivery company in Turkey. The company was set up 5 years ago and is already highly profitable, exceeding all founders' revenue targets by a wide margin every quarter. The founder in the company, majority shareholder and chief executive officer, and he would like to repeat this success in the new territories. Now, particularly in the location where the market has been slow to develop so far, the board is due to meet next week to review a potential expansion. Founder is majority shareholder. Yes. Now, next. Uzbekistan's currency is Uzbekistani dollars, and today's exchange rate is 3.82 Turkish lira per dollar. Based on Black Bosca's company's experience in its home currency, Yes. The board believes that revenue growth in early stage of a new market is likely to be non-linear. The company has therefore hired a consultant who has modeled the project revenue based on exponential mathematical function. The function takes into account inputs as the potential size of the market, the rate at which the customer are likely to adopt the new technology, as well as reaction from competitors. B company's consultant estimate that Ford will earn a pre-tax contribution margin of 40% throughout the project 4-year life and have provided following inflation-adjusted cash flows. They are here, $1 million contribution, fixed operating costs. The director planned to discuss the reliability of model underpinning these cash flow estimates at the board meeting. The CEO's main concern are that the model is untested, and that a mathematical equation is too much of a simplification to accurately model a complex scenario. I'm loving this question, you know. You know what is happening? ACCA exam now they are changing the pattern. You see the discussion on this mathematical models. I'm enjoying it. Now, so he also questioned the validity of estimated fixed operating costs. So we have to discuss the CEO's concern. Here is the CEO. What CEO is saying. Okay. This is what CEO is saying. I'm sorry. B company's finance sector has provided additional information to the project in if the project is approved. It will need to make an immediate investment of $220 million in plan, which is now expected to recover at the end of the life. Tax allowable deficit is annual rate of 20% on the cost. They receive a royalty payment from investment in Uzbekistan payable annually. The first year royalty is fixed at $2.5 million, but will increase annually at 5%. Great. The annual rate of corporate tax is 20% compared to 15% in Turkey. So the life is easy. The taxes are paid in the same year. The tax authority allow company to carry forward losses and offset against future trading profits. It may create a problem. Immediately, this came to my mind. A bilateral tax treaty exists between the two countries. The treaty permits B company to offset overseas tax against any domestic tax, which is incurred as a result of overseas earnings. Oh, yes. Now, the project will also require an investment in working capital at the start of each year, equivalent to 2% of pre-tax contribution. It is expected that will be released back at full, intends to extract a positive free cash flow as dividend as early as possible opportunity. The annual inflation is expected to constant at 3% and 12% in Turkey. Predicted exchange rate, they have calculated themselves. Now we are going to solve it. I'm sorry. So, cost of capital is 16%. Let us start doing it. I'm sorry. So we will be opening the Excel sheet. Oxwick, let me save it. Oxwick company. Oxwick company. Yes. I'm sorry. So the question is, Black, that's very difficult name, Black Bosca company. Black Bosca company. Right. So students, we have to calculate NPV of the project, whether it is feasible or not. It is international investment appraisal again. So investment appraisal will be revised here. Now, so year 1, 2, 3, 4. So evaluation of the project. So pre-tax contribution we need. That is 44 million, 55.2, 185.2, 464 point, yes, 464. Next is fixed operating cost. That is negative 74, negative 55.2, negative 185.2, negative, sorry, negative 93, I'm sorry, negative 93, negative 116, and negative 145. Here are the fixed operating costs. Next is we have to do some working. This here royalty is one allowable expense and tax allowable deficit. Two things we have to calculate. Okay. So first of all, royalty. Royalty is 2.5 million first year. And then it will increase by 5%. It will increase by 5%. Then is tax allowable depreciation. %25 of plant and machinery. You see here. Tax allowable depreciation. 25% of plant and machinery, 220. Same. Now, so here are taxable profits. Yes. They say that tax loss, I highlighted here. Tax losses you can carry forward against the future. Now, so carry forward tax losses. Yes. 11.4 can be carried for the tax purposes we are writing. And how much is there? This plus this minus 11.4. We can charge all. 11.4 charged here already. Okay, so this will be charged here. So now here is the adjusted taxable profit. Student, this calculation is clear. Carry forwarding. Tell me, or should I re-explain it? Tell me, please. Is that clear? To this loss total, first will be offset up to this here, remaining here. So adjusted taxable profit. Now, so taxable profit here 0, no taxable profit here. No taxable profit here. No taxable profit here. Because it will not be taxed. This is the tax. Now, listen everyone. So students, then is the tax payment 20% in the same year here, minus 0.2 into this. This is the tax payment. Now add back depreciation. Tax has been paid. That is equal to 55. Add back. Now, post-tax profit, post-tax cash flows. Now, focus everyone. This, yes, plus this. Same will happen here. Same will happen here as well. But here it will be different. Equal to, this was the profit. This is the tax paid. And this is the depreciation. These were adjustment for only reduction of tax. Yes, 302. This adjustment is for this. These two are for adjustment of tax. These two rows. Let me highlight these a bit. These are for adjustment of tax only. This tax calculation only. Otherwise, they have no other role. Now, working capital. So working capital is immediately 2% of that year's pre-tax contribution. Now we have to do working for it. So workings. Working capital. We need to calculate. So first of all, year 1, 2, 3, and 4. So we will copy the contribution. Is it 2% of pre-tax contribution? They said that. 2% at the start of each year. 2% of that year. So year 0 at start. So working capital level required. this into 2%. 2% of that year. At the start means the previous year. The level required. Now, the next point is incremental working capital. Let me do it rounding off to one digit. Yes. Incremental. This initial outflow, this is level needed. It is already outflow. It is already outflow. The difference will be outflow. The difference will be the outflow, incremental. Simple is that. And they said the whole working capital will be recovered at the end of the project. So the whole is this. It will be recovered at the end of the project. So working capital adjustment. Yes. Here you go. So students, the next is initial investment that's remaining behind. I told you yesterday that when you are solving the question, you should have the whole questions format in your 220 million. So yes. So cash flows. In which country it is? Uzbekistani project. Sum from here to here. So these are the cash flows. Yes. The next point is the next point is now remitting to the home country. Exchange rate they have given. They have given exchange rate. This is the exchange rate. Otherwise, we would have to calculate that. So I will write exchange rate here. Exchange rates here. So exchange rate. So rate TL per dollar. Currently 3.82, 4.15, 4.51, 4.9, and 5.33. So these are the, yes. Now students, cash flows in Turkish lira. We will convert that into that. It is in dollars. So $1 is 3 Turkish lira. This multiplied by this. $1 is 3 Turkish lira. So converted cash flows are here. Now royalty is paid there at this amount. And royalty is income here, inflow. Now focus here. Royalty income equal to, focus here, everyone. I want to show you the bigger picture. Let's see. This is royalty in dollars. This is every year exchange rate of that year. Multiply it because it will be received in Turkish lira. And since it is negative, I will add another negative here to make it positive. Okay. Here it will be income below. Income for the parent company. So simply drag it here. Simple is that. Yes. I can show you again. This negative has been added because it is income below. It is negative mentioned above. Now, tax on royalties. You in home country, you have to pay tax. In Turkey, it is 15% tax rate. They mentioned in the question. Here it is. 15%. Negative 15% into this royalties. Tax on royalties. So net cash flows are here now in Turkish lira. Yes. Turkish lira, a million. From here to here. Now, discount rates, they have given us how much it is. %16. Black Bosca's cost of capital. So present value at the rate of 16%. Here is your 0. Yes. Equal to this into 1.16 raised to power minus here you are. Now, students, NPV of the project. Sum from here to here. NPV is here, millions. Now, so 34.2 million. That's what I'm checking actually. You see, already total losses are here. And I have just 11.4. Oh, you are right. You are right. Actually, I have to add this. You are right. Yes. Now it's okay. You are right. Now it's fixed. You are right. It's okay now. It is fixed. It's correct. Thank you. because 11.4 is already charged here. You're right. So it is done. So students, evaluation. So what is the requirement? The requirement is that evaluate the suitability of investment, analysis of estimates, analysis on discussion of chief concern about cash flow estimates, chief executive's concern. Okay, here it is. So first of all, we will evaluate. Yes. So because year 4 cash flow is actually playing the major role in everything. You see, year 4, that's it. Everything else is negative. So let me write it here, evaluation. So NPV of the project here. Yes, okay. NPV of the project is positive, and based on it, project should be accepted. But it is important to assess the cash flows accuracy in detail, as positive NPV is just because of year 4 cash flows, which are substantial in amount, which are substantial in amount. Now, so chief executive officer's concern, we have to evaluate that. Evaluation of CEO's concerns. So, students, 5 marks are available. 1 mark is for this. So we can say 4 marks are for this. For example, let me copy it. Yeah. The model is untested. So he might be right as well incorrect, wrong. That's too much of simplification to accurately model a complex scenario. He's questioning the validity of fixed cost as well. Now, so CEO is questioning the validity of the model and saying it is too simple. Too simple. If the model is representing the real scenario and facts, then there is no harm rather in using it. rather than it is beneficial for the company to have such predictive models. Yes, but the point to be investigated is that model is based on accurate assumptions and data. Yes. So you see here. This is the model details. Revenue growth is nonlinear. Okay, now how evaluation we are doing of his comments. So this, the linkage of variables, the linkage of the variables used in model and the data collected from the market about market size, revenue growth, and cost contribution needs to be thoroughly investigated. Yes, that's correct. For its reliability. Now, these linkages. So he says, now he's saying revenues are non-linear, but fixed cost is the same. It is a linear. Validity of estimated fixed operating cost. Now, Chief CEO is right in questioning that if revenue is non-linear growth, having why fixed cost is having linear growth. Yes. And this may be inaccurate and NPV may fall to negative if fixed cost is estimated incorrectly. Negative. Yes. So here you go. That's the end of this question. Students, we have completed this paper today. So we'll be meeting. I'm thinking if I can have one class during the week in evening, 2 hour or 2.5 hour. Can I conduct a class during the week on a short notice. And class, if I conduct, I'll be conducting at this time. So will means in during weekdays. Is it possible for you to join? For example, if I conduct this class on Tuesday, 2 hours class. All right. So students, most likely I will be conducting it. So I will confirm it in the WhatsApp group. Okay. So thank you for joining me. See you on in the next class. Take care. Goodbye. Goodbye.